Like, what are we
Correct.
supposed to do over the next 10 days?
I mean, that's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom or have historically bottomed before the event actually happens. You know, the best example is 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? Put that on top of what we've already heard. Are you concerned about where the economy's going?
I mean, it's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. You know, CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
Tom Lee discusses the current state of market volatility and how historical patterns suggest potential recovery ahead of key event. Drawing from past examples, such as the 1962 crisis, he explains that markets often bottom before resolutions are visible, creating opportunities for sharp rebounds. He highlights that fears surrounding tariffs and economic uncertainty have created an overly pessimistic environment, setting the stage for a positive surprise if trade negotiations or delays occur. Bitcoin, behaving like a risk asset, stands to gain significantly in a broader market recovery. Lee also sheds light on Bitcoin's transformative role in the financial ecosystem, emphasizing the significance of spot ETFs and institutional adoption. He notes that major corporations and governments are increasingly recognizing Bitcoin's value, with ETFs offering a streamlined path for acquiring Bitcoin. This institutional interest, coupled with a favorable macroeconomic backdrop, positions Bitcoin as a key asset in reshaping investment strategies and accelerating its mainstream adoption. As the Federal Reserve signals a potentially softer stance and optimism builds around trade agreements, Lee believes both the equity and cryptocurrency markets are poised for growth. He views Bitcoin as not just a speculative asset but a fundamental part of the modern investment landscape. With the crypto market adapting to these dynamics, investors are presented with a unique opportunity to leverage Bitcoin's potential in the evolving economic framework.
Part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist. What do you make of it?
Well, I think markets should interpret it positively because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses, and I think it would set the stage for a much bigger recovery rally than we expect. When the S&P had a 10% drawdown, that's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the market
weakness.
the real economy?
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence. Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. One of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again. I think markets were positively surprised by the Fed's move, in part because recent staff papers from the Fed had argued tariffs would actually be multi-year inflationary effects. So Fed Chair Powell's comments yesterday, I think, did catch a lot of folks by surprise, just because it is a view that markets probably want to hear, that they'd like to hear that the Fed is viewing tariffs as possibly transitory, because that puts them in a position to actually intervene if labor markets start to weaken. And in fact, that's evident in the SEP, because 90% of Fed staffers now see not only risk to growth, the GDP growth forecast, but it was 90% seeing it as downside risk. I think that the sort of the big elephant in the room has been the absolute fear that has become systematic in markets around April 2nd and the tariff deadlines. And I think that there have been little hints this week that instead of April 2nd being the date of some sort of annihilation of trade relationships, that we may start to see either deals before then or even delays in implementation. And I think that really investors are going to breathe a sigh of relief because, as you can tell, pessimism has become very pervasive because of the fears of what will happen on April 2. So I think that's a positive. And then the other is, and it's really a technical perspective, but Mark Newton, our head of technical strategy, has pointed out there are increasing signs of that we've actually established a tradable bottom. And that's not only the fact that we declined so quickly, but it's that market breadth has really been expanding and then actually following through in a way that looks like this is not a 10% decline that's leading to a 20%, but a 10% waterfall decline / heart attack for stocks driven by rage selling, and now it's tradable. I'd say that probably the final thing that I've seen is, and this is really from our meeting with clients, is that we know there's actually quite a lot of dry powder. Many of our clients have raised a lot of cash. I mean, it's also evident in a lot of the money market balances or prime brokerage de-risking that's taken place. And it's at a time when investor sentiment has moved far more than is justified by the market moves. Whether you look at AAII or Investors Intelligence, both have registered recession-like readings and sentiment. And so it really creates the room for positive surprise. And that, again, I think it like what you just said, if tariff headlines aren't as bearish and if there's all this last-minute work on negotiating something, and yesterday there was a tweet about how into the night Hessett and Lutnick and Bessent were, working on a trade deal. That got so little notice. I think it just tells me markets could be positively surprised.
Tom Lee explores the current market turbulence, emphasizing how historical patterns often point to recovery before crises are resolved. Using examples like the 1962 crisis, he highlights that markets tend to bottom out early, allowing for potential gains before resolutions become apparent. This, combined with the current climate of trade negotiations and Federal Reserve signals, presents a unique opportunity for both equities and cryptocurrencies like Bitcoin. Lee notes Bitcoin's increased alignment with risk assets, suggesting that any market recovery could drive significant growth in its value. Moreover, Lee underscores the transformative impact of institutional Bitcoin adoption, particularly through the introduction of spot ETF. These ETFs simplify access for major corporations and institutional investors, fueling mainstream integration of cryptocurrencies. As the financial landscape evolves, Lee sees Bitcoin becoming a critical part of diversified investment strategies, providing a hedge against traditional economic challenges. With growing optimism around trade and policy outcomes, he encourages investors to position themselves for potential market upswings while capitalizing on Bitcoin's expanding role in the global financial system.
Tom, what usually happens when the Fed cuts and there's a no landing scenario or a soft landing? What are we looking at here?
Yes, this table shows you how progressively over time, when a Fed cuts and there is no recession, it is hugely positive for the equity market, because when you get to 3 months out, the 7 of 7 times when the cutting cycle starts, stocks have never been lower. And 6 months out, never been lower. And 12 months out, never been lower, with a median gain of 16%, which is better than a typical 12-month return for stock. So the key is whether or not...
just for the listener, these instances, January of 71, October, am I in the right column?
Yes.
The Fed cut and we don't have a recession. This is what happens. So those examples, January 71, October 84, October 87, June 89, July 95, September 98, that one I remember, July 19, that one I remember too. So in these instances, if you're not going to have a recession and you have the Fed cutting over the next 3 to 6 months, it's 100% historical win ratio for stocks.
Yeah.
That's really powerful.
That's right. And it kind of defies how, as you know, a lot of skeptics said, oh, the Fed has never had a soft landing ever, but there's been many instances of no landing. So I think it's almost...
Do people say that? Never had a soft landing?
Yeah, well, there's still...
I guess I've heard.
Well, how many times has inflation been above 9%? Twice?
Yeah.
Once?
Yeah, that's right.
In World War II, right, come on. So what are we doing here? We're talking a lot about the perfect macro backdrop. Stocks are breaking out. Everything is kumbaya. what do you think are some of the what are the biggest risks that we should perhaps pay attention to?
Well, we surveyed our clients yesterday, like 1,200 responses, and the top concern is geopolitical. So is
Which
there?
makes sense.
Come on,
Makes sense.
it's always that.
Yeah, and it's hard to actually make an investment action on this unless it's World War III, right? And the second is the elections and this is like something where it's like a little bit how you want to position around it, but most people can't have conviction about what they do until they know who's in the White House, even though it shouldn't matter.
Professionals or regular people?
It's the in between. So let's say it's a family office
Okay.
where they, as you know, family offices, let's say as a cohort, probably were more cautious the last 2 years. So now see the Fed cutting and they want to actually invest, but they want to time it so they have to make the second decision to get back in. And so I think they want to wait till after the election.
I see they're playing it like Buffett.
No, but you raise
It's
a good
a long
point.
term, short term.
A family office is a lot of money, but very often answerable to one or two family members.
Yeah.
And it's not like if you piss off that client, all right, it sucks, I'll just deal with my other clients. You only have one client. And if you have a client where they'll be mad, if you get really aggressive in front of the election and then there's an election-related sell-off, you're just not going to risk it.
Yeah. And they want to preserve capital.
You'd rather buy higher.
That's right. They want to preserve capital. And also, then they're also glomming onto the idea, well, EM, especially China, has lagged and they don't mind being late, or they might even be involved there because it's not election sensitive, right?
Tom Lee delves into the intricate dynamics of market volatility, drawing parallels with past events to offer a cautiously optimistic outlook. He highlights that markets often bottom before major resolutions, citing historical examples like the 1962 crisis. Amid the current turbulence, factors such as Federal Reserve actions, trade negotiations, and investor sentiment play pivotal roles in shaping near-term market trajectories. Lee emphasizes that this environment also sets the stage for Bitcoin's growth, particularly as it increasingly behaves like a risk asset that could surge alongside equity market recoveries. Additionally, Lee points to the transformative impact of institutional involvement, particularly through Bitcoin's spot ETF. These tools simplify access for institutional investors, fostering a broader acceptance of cryptocurrencies. He suggests that as traditional markets stabilize, Bitcoin's role as a key financial asset will expand, presenting long-term opportunities for investors. With optimism surrounding trade deals and potential policy shifts, Lee underscores the importance of strategic positioning to benefit from potential market recoveries and Bitcoin's evolving role in the global financial system. What role do you see Bitcoin playing in a recovering market, given its increasing correlation with risk assets? How should investors approach the uncertainty surrounding trade negotiations and market volatility in their portfolios? Share your thoughts below, and let's discuss the answers.